watching us here on CNBC TV18's web programming. We're covering the budget 2024 Go for Growth live here for all of you. The budget speech by the Finance Minister, the record 7th consecutive budget speech by Finance Minister Nirmala Sitharaman is over. It was 1 hour 24 minutes long, among her shorter speeches that we've seen. I'm Mangalam Maloo. With me is Sonal Bhutra, and we will talk about the key takeaways from the budget for you, your finances, your investments, and the markets at large. Hi, Sonal.
Hey, Mangalam, and there have been so many changes, right? And it was definitely a tax evolution budget, because we've seen so many changes in taxes, not only for stock markets, not only for personal finance, but in terms of your assets you hold as well, what you get from companies in terms of your dividends, your buybacks. So there have been a lot of changes. But let's start with the budget math, the big numbers, because this time around there was a thought that maybe capex will increase, maybe there'll be more cushion in terms of fiscal headway because of that big dividend from the RBI. What did the numbers look like?
Well, let's talk about the budget in three forms. One, what was expected, what's in line with expectations from a stock market standpoint, then all the personal taxes that you spoke about, and finally we get stock specific as well. So the big numbers first, what's in line with expectations. Everyone was expecting, some sort of capex momentum to continue, and that is virtually unchanged. Remember, there was a big jump in capex that was announced in the interim budget itself, 11.1 lakh crores, which amounts to about 3.5% of the GDP itself. The government has maintained that. There were expectations of a slight increase out there, but those expectations were largely unfounded, largely because of a big jump that the government had already announced in the interim budget. So that it wasn't reduced is a big positive. Secondly, with the capex being increased, with a lot of these schemes seeing a lot more money and some of these income tax related benefits that the government has given as well, one would have thought that maybe they may slide down the path of a bit of fiscal prudence that may be pushed down down the road. That hasn't been the case. In fact, the finance minister has gone ahead and reiterated the fiscal deficit target of 4.9%. Most on the street were anticipating a number between 5 to 5.1%. There were a couple of outliers expecting 4.9% in terms of fiscal deficit. What exactly is fiscal deficit? Basically, the money that the government spends versus the money that the government receives. The difference between that is usually the fiscal deficit, which is now maintained at 4.9% of the GDP itself. So those big numbers, no problems whatsoever, absolutely in line with expectations.
But, they are in line with expectations, but just on that capex number of 11.11 lakh crore rupees, somewhere some of the market participants were thinking, because of that extra receipt that has come in from the RBI dividend in form of dividend, they would see some increase there. That's why some of these infrastructure stocks, the big name like L&T, you have the other names in the infrastructure space, they did see a fall from the highs, because maybe somewhere in the minds of investors there was a thought that that number could increase. But yes, it has been as is, 11.1 lakh crore rupees. This is 3.4% of the GDP, absolutely unchanged versus what was given in the interim budget. But the big talking point this time, and it has to be what happened with the STT number, with the numbers that changed in terms of taxation on options and F&O trades. Markets, RBI in terms of their warnings, the SEBI chief, yesterday we saw it in terms of the economic survey as well. They're worried that a lot of these inexperienced retail investors are going ahead and investing in F&O, making losses but not understanding the depth of it. So they've gone ahead and increased taxes there.
They've gone ahead and increased taxes there. So a lot on the street were already anticipating some sort of tinkering coming by to the long-term capital gains, and that is exactly what has happened. So a couple of things. Let's put all the stock market related taxation news into perspective. The long-term capital gains, basically, if you hold a stock for more than a year, a lot earlier, it was absolutely tax-free. Thereafter, Finance Minister Arun Jaitley increased that to 10%, introduced the LTCG, and now it has been increased from 10% to 12.5%. So if you buy a share today and you hold it for more than 1 year, you will have to pay 10%, 12.5% tax on the gains that you make on that investment itself. Earlier, that number was 10%. But remember, this is done in line to, protect the stock markets from actually seeing a lot of speculation in the markets itself. And secondly, one would say, oh, is this, impacting the retail equity cult? No, because at the same time, the LTCG limit has been increased from 1 lakh rupees to 1.25 lakh rupees. How does that, work? So if you invested 1 lakh rupees in a share today, and 1 year later that was worth 2 lakh rupees, then you wouldn't have to pay any LTCG because your long-term capital gains tax was 1 lakh rupees on the 1 lakh that you had invested. Now, all the way up to 2.25 lakh rupees, you won't have to pay any tax because that limit has been increased from 1 lakh rupees to 1.25 lakh rupees. So if you invested 1 lakh rupees in a stock this year, next year the stock becomes 2.25 lakh rupees, you still don't have to pay any LTCG. That is point number one. Secondly, short-term capital gains tax on certain financial instruments have been increased from 15% to 20%. What those assets are, we still don't know. We need clarity on that. The big bane of all the regulators that you were talking about, right from the RBI to the finance minister to the economic survey to the SEBI chief as well, speaking about increased activity in the FNO trades and the risk that may increase, as a result of which securities transaction tax, or STT as we know it, on index futures and stock futures has been increased from 0.01% to 0.02%. So in effect, that has been doubled. And secondly, on options as well, has almost been doubled from 0.06% to 0.1%. So those two are factors that may, have a bit of a limiting activity in, what do you call it, unexpected adventurism in the FNO trades itself. And finally, the big announcement that came in was buybacks will now be chargeable in the hands of recipients. Correct. So if you've tendered a stock for buyback, your stock gets bought back, then the gains that you get, you will be taxed on it, as against earlier, where if you got a dividend income, that would be taxed. So they're basically putting buybacks and dividends at the same part.
It takes away the arbitrage from dividends,
yes.
and it's around 20% is what I believe.
That's
the
correct.
tax has been levied on buybacks. So that's what's impacting the stock markets. While that came in as a bit of a disappointment, right?
Tell me, how do I save my tax? I mean, the money that I pay to the government on the salary that I earn, are there any benefits there?
So you save taxes only if you're under the new tax regime. There's nothing for the old tax regime, because that's been the government's stand as well, right? That they want to do away with all the exemptions that are there in the old tax regime. Now, just to give some perspective, new tax regime is the one where you do not get any exemptions. The ATC, the ATDs, the ATEs of the world, there is no exemption whatsoever. There's just standard deduction that you will be getting. Now, on that, there has been an increase. The standard deduction has increased from 50,000 rupees that you got generally on your income to 75,000 rupees. That is not it. The family pension standard deduction has increased from 15,000 to 20,000 rupees. Again, this is only for individuals who have adopted or opted for the new tax regime, and as Finance Minister Nirmala Sitharaman was mentioning, around 2/3 of the taxpayers, they've moved to new tax regime, and the general calculation also shows that if you earn more than 15 lakh rupees, this is a regime which will be very beneficial for you as well. So this is what happened with the standard deduction or the general deductions that we saw in the new tax regime. There has been a rate change as well in the tax slabs. Again, it is again for the new tax regime. It is not for the old tax regime. So just to give you a perspective, the revised tax structure now, so 0 to 3 lakhs, you don't have to pay any tax. That's unchanged. That's as is, which was earlier. Now, 3 to 7 lakh rupees, you will be paying 5% tax. Earlier, you would pay 5% tax for 3 to 6 lakh rupees if that was your slab. 7 to 10 lakh rupees, it will be 10% taxes versus 10% that you paid for 6 to 9 lakh rupees. So basically, they've tried to bring down the slab levels and reduce the taxation as well on different levels. For 10 to 12 lakh rupees, you have to pay 15% taxes versus 15% for 9 to 12 lakh rupees before. 12 to 15 lakh rupees, you still have to pay 20%. That's unchanged. That was the case before. Above 15 lakh rupees, again, you have to pay 30%. That's been unchanged again. The finance minister said this could save up to 17,500 rupees for an individual in terms of income tax. And while people would say it's not that big an amount, it does make a difference.
Yes.
If you move or you go for this tax regime, but again, you have to make those calculations. But there has been some relief in form of personal taxation, but it has come in only for those who have new tax regime.
All right, so another incentive from the government's end for you to actually look at the new tax regime. Of course, these are what the finance minister has said, and you will obviously speak to your financial advisors, your CAs, etc., to discuss with them your tax plans, etc. as well. But now that we're talking about taxes, we've spoken about the markets, we've spoken about the big numbers, let's get micro. A lot of stocks in an otherwise wobbly market post-budget that is expected. Two stocks really stand out. The top Nifty gainer as we speak right now, up 6%, is Titan.
Wow.
Why is that? Because the government has gone ahead and announced a reduction in basic customs duty for gold and silver. This number was 10% earlier. This has now been reduced to 6%. Remember, this is not a 10 to 6% sort of number which seems very small. What happens is, including GST, tax on gold and silver was close to around 18.5%. With this reduction, post-tax incidents, post-GST tax incidents on gold and silver actually reduces from 18.5% to 9.2%. And that 9% on a big ticket item like jewelry makes a very big difference, because gold prices have been increasing, as a result of which consumer sentiment was a little down. At the same time, the first quarter had lower wedding dates, and again, dismal consumer sentiment because of the election, the heat waves, and lower festivals, etc. as well. So Titan understandably posted a dismal first quarter update itself. But now with a benefit of tax benefit coming in, with the government announcing this, reducing tax incidence by about 9%, the street is expecting a positive second quarter and much beyond as well. And as you can see, we have a big move on Titan, up 6%. The other one is ITC. Every budget, ITC has been the most volatile stock, at times moving anywhere between 10 to 12% intraday as well. And right now, as we speak, it's up 5%, because what was feared has not happened. There has been no changes in the tobacco taxation which has been announced. Secondly, ITC as a stock was absolutely flat over the last 12 months, at a time when a lot of these other FMCG stocks are doing well. And recovery and rural demand, given the kind of push that the government has given, you've spoken about how they are helping us save taxes worth nearly 17,000-18,000 rupees per year as well. All of that will aid their non-tobacco business. And because the stock hasn't moved in the last 1 year or so, it's still trading at 26 times 1 year forward earnings, a value buy at a time when everything else is a lot more expensive. So those are my two stocks that I'm looking at in the budget. But what about you?
I'm looking at a sector as a whole, the real estate space, because we've been talking about the changes in capital gains tax. The document also mentioned that the government will go ahead and reduce long-term capital gains on real estate, the property taxes and unlisted shares from 20% to 12.5%. This is the long-term capital gains tax. The short-term capital gains tax remain at 20%. Now, what is important to understand in this is, usually long-term capital gains come with indexation. But here there has been a big cut, right? 20 to 12.5% on something like property sales. So that would mean that there's a possibility that indexation benefit would not be available. Indexation basically adjusts your cost of acquisition to current pricing, basically adjusting for inflation as well. So that is the clarity that we need right now. But this is a big news that...
In fact, as we speak, there is some clarity. It says that the indexation has been removed for property as well. There is no mention of indexation continuing for property in the annexure shared above.
That was the big question, because if you are reducing the rates and then providing indexation, that is a big benefit. But that's also surprising because land does not get any indexation, right? Land is an asset where when you calculate capital gains, you cannot account for indexation. So that was the only asset where you did not account for indexation when you calculate a long-term capital gains. And now if that happens with property as well, when we are talking about long-term gains, then that would just mean that yes, you're getting some benefit in terms of reduced rate, but cost is still very low. It is from the period.
Yes.
If you bought something in 1981, maybe the land wouldn't have costed so much, right? But in today's pay parity, that would be a bigger amount. So that goes away. So while it's positive, it's not so positive as it looked at the initial time.
Okay, so the positives and negatives offset each other, as a result of which we've seen the stock prices come off as well, down about 2% for DLF and 1.5% for Godrej Properties as well. So that is the sum and substance of our budget coverage so far. What's in line is that the fact the government has not gone ahead and increased capex or reduced capex as well. That stays at around 11.1 lakh crores. Fiscal deficit 4.9%. Fiscal prudence measures. There were measures to curb some F&O trading activity by increasing STT. A mild increase is what we saw on long-term capital gains tax as well, from 10% to 12.5% for equity markets. But this comes in with the increased exemption limit from 1 lakh to 1.25 lakh as well. Some benefits for all new income tax payers or income tax payers under the new tax regime. That would save them up to 17,500 rupees every year, and a lot of stocks which are in focus as well.
Just one clarity here. We were talking about whether it would be retrospective, prospective. They are effective immediately. So it's not anything like a retrospective taxation. So it is prospective. From today, it will be effective, and that is something that everyone should take care of in terms of standard deduction, in terms of the F&O taxes as well, and STT increase as well.
Right. So that is the sum and substance of Budget 2024, the 1 hour, 24-minute long speech of the Finance Minister. There would be a lot more detailed analysis coming for you on CNBC TV18 and all the web and allied channels. But this is our first take. A lot of stocks in focus, markets also, along with the big economic numbers. Thank you for watching.
Andhra Pradesh